Equities are rallying today as excitement around earnings from tech giants is getting the market real frothy. We're going to be discussing that, how the reverse repo is coming to fuck every single one of us, and much more today on Money Never Sleeps. Welcome back, ladies and gentlemen. As we get going today, do us a favor, hit that like button, subscribe to our channel. Nothing that Kevin or I say is financial advice, so please do your own research before making any sorts of buys or sells. Kevin, we got Amazon, we got Apple, we got Meta, all reporting in a little over an hour. Around 4:15 Eastern is when we start to see those reports trickling in. The market is excited. Things are calming down after Powell's presser yesterday. People are starting to get bullish again, thinking that, hey, maybe some of this jobs data is going to let us get some interest rate cuts sooner. I don't think I believe that. I know you don't believe that either. But what do you believe about what's going on in the markets today?
Yeah, I mean, I don't believe anything. I think what you and I do for a living is we call bullshit on people. Like we're pretty much like human lie detectors at this point, and we're just seeing where the lies lie. Lay. I don't know what the proper English term for the or way to structure that sentence. But what I'm seeing is that we have tech earnings today, and the market had a really bad day yesterday. So I think that they're buying into it. This is the one I was worried about. I thought that we were going to stay somewhat flat going into earnings today because this is such a huge deal. We saw that Google did not do well. We saw that Tesla has not done well. So the Magnificent Seven is pretty much a Magnificent Five right now, if we are being honest. You're going to find out if there's a few more that drop out of that category today. I think there's at least one that is fucking doomed, but I can't guarantee that. It just doesn't make sense right now how they're able to do or what their valuation is currently compared to what this company probably produces. Well, you guys probably know from the thumbnail who it is, but it doesn't make a lot of sense to me. I think there's a good chance that we could see a bit of a sell-off either tomorrow or post-market if the numbers come in bad. But I think the market is just kind of preparing itself, hoping that this is a dip, but I think they're going to keep selling each rally. Well, that remains to be seen, but I think there's a good chance that that's where we stand today, the market pumping up as much as it is.
Yeah, it's going to be, once again, headline numbers, what the forecast is. What, with Facebook, a lot of it is with ad revenue, right? So our businesses spending less on ad revenue? Are small businesses struggling and having to spend less? Like, where is their money coming from right now? I can tell you it's not from fucking Threads. They're not. I don't think they're getting a whole lot of ad revenue from that disaster of a thing. But so we have that. What are with Apple? You mentioned the Vision Pro. I think that's just kind of the running joke at the moment. So many
It's
people
the best joke ever.
It's so good. So many, all the memes on Twitter about, people put on their Vision Pro and working and what they're doing with it. It's some good stuff. And then with Amazon, that's another one with the probably Llama AI. What are you talking about? For Meta. Okay. Llama AI. I love it. And then with Amazon, once again, what's the consumer up to? Like, there's no more, Amazon days or Prime days to boost boost revenue for the coming quarter. So what are they going to be looking at there? How is consumer sentiment? We can talk. Let's talk about debt for a second here, because you had sent to, I believe, our group chat with House the text from, I believe, Unusual Whales, whoever it was, kind of showing how you have so many weird accounts that you follow and send stuff to me, like Bull and cat like, yeah, all that shit. Basically showing the household debt broken up into credit cards and auto loans and mortgages and student debt, and it is crazy right now. Like, and maybe it's one of those things where it's always, the can is just going to get kicked down the road forever. People are always going to pay off the minimum. They're always going to be able to borrow more. It's just this cycle that we never exit. And maybe it just doesn't matter. Does any of this even matter anymore, Kevin? I don't even know. I have no clue. I've like at my wit's end with a lot of it.
Yeah, it matters. It's just that we're choosing it not to be as much of a prevalent issue as it should be. But at the end of the day, that does come.
And when does it become a prevalent issue if everyone's just gonna like kind of ignore it?
Well, when it gets too
Never
big,
matter.
to the point where the debt just gets called in, right? That's the unfortunate thing, and that's why the banks are in such a bad place right now, and why Powell saying what he said yesterday, he's putting more stress on the banking sector, right? These rates are not sustainable for any of these institutions to be operating this high. I mean, obviously, people are accumulating more debt now because there is no source of lending out there. Because these banks aren't lending nearly as much, they can't create new debt, and that just causes debt to keep piling up because nobody can pay it off. And again, who wants to be paying off stuff at this level, this interest rate? And the thing is, too, it's like, well, if I don't have capital, if I don't have cash, because maybe things are slowing down at work, maybe I don't have that money coming in like I did back in 2020, 2021, then it's like, well, I have to use a credit card, right? And it just keeps building up, building up, building up to the point where the bubble's too big and everyone's in deep shit. And I think it's very similar in some ways to 2008, where the debt is going to pop and you're going to start seeing tons of bankruptcies. You're already seeing a lot of bankruptcies going into, year over year from January or so 2022 or 2023 into 2024. A lot of bankruptcies have accumulated over the past year. But, you know, when it does break, it's going to be faster than people anticipate. And I think that's the crazy thing, because we haven't seen any type of correction in the market. We haven't seen any type of pressure release from any of the things that have just been mounting against the consumer. The government spending continues to go out of control. And some of those numbers that were on that post are just absolutely mind-boggling, right? Imagine if you're a family that's got a few kids in college, you're also paying off your student loans at the same time. You got two cars, and I don't know, maybe
Lord.
things that were slowing down, and you got credit card bills that are paying for your groceries, paying for your mortgage, stuff like that. So it's very dangerous out there, and that's like playing hot potato with a bundle of dynamite at this point. Wick's going to run out pretty soon. When it does, though, don't want to be holding that.
Yeah, I'm trying to find the exact numbers here, but I am struggling to do so at the moment. It doesn't matter. We can move on to something else. Let's talk about reverse repos. And I know this is something that you have been all over, keeping a very close eye on it. Similar to the other day, what I would like you to do is pull up the numbers, pull up the chart, and then give us like a 60-second, we've done it before, but like a very basic level of what this is and why this fucking matters.
Absolutely. So where we are right now on this chart, this is from TradingView. $615 billion remains in the reverse repo. This is the overnight program. So pretty much that's when banks and the Federal Reserve swap treasuries for cash, and then they pay it back, obviously buying it back, and they get a certain percentage back. And it works out because this helps a lot of other banks, that are short on balance sheets, just trade over. So imagine say JP Morgan has $3 billion worth of transactions. Someone else has, say, $4 billion worth of transactions in their banks between customers that are trading or paying between each other. Well, then the reverse repo would just be like, all right, just give me the difference and we'll call it even, right? So that's what a lot of the reverse repo is. And again, a lot of that also comes up with just some of those treasuries and other assets and collateral that pretty much allow banks to borrow so they get cash on hand fast. The problem with it right now is that we're pretty much due for this to expire by March. The problem also is that we're looking at 615 here. This has not been updated. We got the news today that it was considerably lower where we currently sit on the reverse repo. I'm going to pull this right here. We're sitting at that red line. This is 505. Let's see if I can get 503, 502 right there. That's good enough. But that is pretty much about a 19% drop. Almost 18% it says there. 18% drop from where we are in one day. That is $112 billion that it dropped. Now, this is really concerning because of what happens with the federal, the federal funds rate. The fact that it's probably going to stay elevated for a period of time. That means liquidity is an issue, and these banks probably need more cash on hand than they probably have on hand. So they're draining this. This could get drained fairly fast. I mean, the past few days, it's only been a few billion, but today, 112 billion, that is a major red flag. Get Bank Term Funding Program data tonight. We'll find out how bad these banks are borrowing from these institutions. If it's high again with a higher percentage rate, you know that they're not borrowing for fun or arbitrage. They're 100% borrowing because guess what? They are screwed in terms of capital. There is a collateral and cash shortage, and they are scrambling for it. And market is just not paying attention to any of that right now.
Okay. Appreciate you breaking that down for us. Where else do you think is worth looking? It's earnings week, it's data week. We have unemployment report tomorrow, so we'll get, jobs added, what the unemployment rate is, all of those good things, hourly wages, stuff like that. What do you think is, kind of the main things that we want to touch on here as we head into the close of market and the release of all those earnings?
I think we're just going to go through a really quick rundown of banks and the regional banking crisis that's going on quietly right now, because it all kind of ties in with everything that's happening in terms of the reverse repo and also international. We got some really bad news internationally today too about banks. So let's pull up the U.S. regional banking shares. This is the article from yesterday, which was talking about New York Community Bank. I believe that's NYCB. That's the one that's dropped down 30 something percent and closed 30% something percent down. But this is from Reuters, obviously on Yahoo Finance. But this is the interesting thing about it. Now, everyone was saying the regional banks are the problem, right? And we've heard that for so long. It's the regional banks, the regional banks, the regional banks. Okay, sure. Because commercial real estate, we understand that those loans are probably going bad. Even worse now with Evergrande probably repricing those. They're saying they're going to get 3.4% of creditors' money back. I highly doubt that. Once they reprice it and see where those values are, it's going to be considerably lower. It's going to be terrible, and then that's going to bleed into every other sector. Any banks that had any debt of Evergrande are also going to lose out on that. So there's going to be a lot of losses that mounts. But the reason I want to get into this first is because everyone's saying this is a regional banking issue and it's coming back. I want to show you exactly why this banking crisis is interconnected. And while there's two different problems between the big banks and the regional banks, they're one and the same, pretty much hand in hand. So I'm pulling this down. I want to find it right here. Here it is. NYCB's purchase of Signature Bank, along with 2020's acquisition of Flagstar Bank, pushed its assets above $100 billion in regulatory threshold that is subject to stricter capital and liquidity requirements. I just mentioned that we have an asset and dollar shortage right now in the world. That's a given. Now we're seeing that a lot of these banks that acquired a lot of debt, bad debt too, right? I mean, Signature Bank, that's a lot of bad debt that this bank bought up. We talked about UBS a lot. UBS and HSBC both bought up a ton of Evergrande debt. I can go down the list forever. But what I'm saying here is now these banks have exposure to one another. So now they have exposure to the big banks. But the big banks, more than anything, are the reason why the smaller ones are also seeing a lot of pain, right? That's the interesting thing here. Everyone's like, oh no, the big banks are fine. Don't worry about that. But when the capital requirements start to get up really high and you don't have the amount of liquidity to match how much money is actually flowing in and out of the system, hence why the reverse repo keeps getting drained, then you start seeing that maybe all these regional banks are actually insolvent right now. And maybe it's just numbers on a screen, and there's a good chance that the assets that are on hand are worth less than the actual dollar value that they're saying are in customer accounts. That's a very scary thing to think about. Now, if one bank thinks like that, all the other banks are going to think like that. People who are investing and have money in these banks, they're going to start withdrawing. It's a very dangerous thing. But the problem with this is the big banks are the ones that are causing a lot of these individual smaller banks to see pain. Signature is causing this one. We've seen Silicon Valley, absolutely hurt other banks. Credit Suisse is killing UBS, right? They bought all that debt back in 2023. Now, the thing that's really interesting with this is something that we got out of the news in Europe last night is what's happening with Deutsche Bank. Deutsche Bank is cutting 3,500 jobs. They're saying they're rewarding shareholders. Okay, fine, sure, whatever. I hope they're doing well. But I talked about Deutsche Bank because we know that they have a lot of exposure to the Japanese market, right? So that's a big problem too. Asia's very bubbly. Let's say that right now. And I don't think any type of debt that you want, cross-border international is the type of debt that you're going to want to survive. Now, we know Deutsche Bank is in Germany. Germany is having tons of problem within itself, but I just want to pull up some of the summary right here because this is really interesting. To cut just under 4% of its workforce, that would be the 3,500. It's mainly back office roles that are affected, but the Q4 profits for Deutsche Bank dropped 30%, but it beat expectations. And that's why these expectations don't fucking matter. I mean, to drop that much, 30%, but oh no, they beat expectations, so it's okay. No, you can't have that mindset right now. You could have that mindset back in 2023 when there was still a little bit of liquidity in the system, but you're seeing what's happening here. There's not enough money for the capital requirements. A lot of these smaller banks got too big and they can't necessarily tackled that. And now you're seeing cross-border international exposure to some of these banks. If they're holding any type of derivatives or any of those packages for other banks, there's a good chance that that's probably why they're seeing some of their profits drop significantly. Now, the interesting thing here is Deutsche Bank's a pretty big bank in Germany. What happens if people see this and they're like, you know what, let me get my money out of there? Well, then you have, once again, another bank run. And what's the problem with all these whale banks? Capital flight. That was the big problem that happened with Silicon Valley. People just started leaving the bank. Same thing that happened with First Republic. Same thing that happened with Signature. So now we're starting to see that everything is absolutely intertwined, and these banks are just in one huge dollar and collateral shortage, and it's absolutely blowing up because debt is being recalled. Evergrande is blowing up a lot of things quietly, especially here in the United States. And I'm talking about, in terms of debt and finance. That's what I meant when I say it's blowing up things in the U.S. But it's really interesting to see how this is starting to play out. It's kind of rolling out fast right now. And these headlines just aren't making the news, right? We're talking about tech stocks and everything like that. So there's two things I want to show you. These are the regional banks ETFs. This is the KRE, something that I've been watching. It doesn't seem to make sense for me to short it. That's why I never shorted it, because it's just have to put a lot of capital and wait for this to happen. It seems like this thing is going to drop, right? It's probably going to give, but it is down today 2.56%. It's bought up a little bit, but if we look at this on the weekly, it's down roughly 7.11%. It was down a lot more earlier. I think from the height to the low, it was down about 12% this week. And we haven't necessarily had anything crazy happen in the regional banking sector in the US. We just had a couple that dropped, 37%, down 8%, 5%. But there are rumblings that there is going to be pain in the regional banking sector. Now, the thing is, people are looking at regional banks. I'm saying we need to look at the big banks, because I think the big banks are equally as bad, and they have very different problems. Now, I look at this is the BKX. This is the big bank index. It's for an ETF. It's on the NASDAQ. If I look at this here, it looks like we got 5 waves down here. And then where we currently sit is A, B, C. If that's our wave 2, we have a massive wave 3 coming down. Doesn't matter what bank it is. I think there's a massive wave coming down here for the big banks. And then we could be, get maybe a bounce before we go into the low for the bear market. But one thing that was also really interesting to me, because no one's talking about this one, and again, the big banks are my concern, nothing else. If we look back at 2008, when they were at the center of the crisis, you can see from high to low, dropped about 85%, right? Went from $121 a share down to $18. Now let's go to the height of this one back in 2021. And let's think of the number 85, right? 85 is right around here. It's at 20.98. That takes us $2 difference from where we were in 2008. And when we zoom out, we see that back here, found support, and even further back, historical support back in the 90s. So when I look at this, I think there is a good chance that the big banks still have a ways to go. And people are just saying that, money is going to fly into these bigger banks when these smaller ones fail. Think about who owns the smaller banks. Chris made a really good point to me yesterday that when they're talking about regional banks, there's no exposure to the big banks. Who owns the smaller banks, right? And now we're seeing even the smaller banks take pretty much ownership of some of these bigger banks' assets. It's absolutely fucked. We're not far away from seeing pain. And I mentioned the bank term funding program. If we know that it jumped from 4.9% to 5.35%, the borrowing rate. If that comes back tonight, significantly higher, over 167 billion, that tells you that there are banks in trouble. It is not an arbitrage opportunity, and that this thing is going to get even worse before we know it. And it doesn't help that the rates are still 5.5. These central banks are going to cut. Whoever cuts first is going to be the one that's going to lead us in. But think about this. It is absolutely intertwined globally. One shoe doesn't drop without the other one falling as well. You could say that China goes first and then all the money flows into the US. Well, what if China's problem is really the same problem that the US is facing and there's a dollar shortage? Well, they're going to do the same thing. It's all interconnected. And I think it's the perfect opportunity for there to be a massive crash in the market. Terrible, terrible scenario that's going on, but it's the most interesting. And I'm very excited talking about it because I've been following for, I don't know, a year and a half now at this point. But yeah, this is if you're short on the banks, I think you can sleep comfortably fairly soon, because things are just lining up for absolute max pain.
Max pain. Okay. That was a very I think well said and well spoken, focus on the banks there. And I think that's good for that portion of it. I will say, if we want to help with financial literacy, one thing that came to mind while you're going through all of that was, right, a children's book. Instead of Alexander and the no good, or the terrible, awful, no good, very bad day, it'll just be Kevin and the terrible, horrible, no good, very bad bank loans.
And it's not great.
And it's not great. So we can start putting that into production, work on that one. And yeah, man. Okay. So we're seeing the markets right now. We're kind of seeing the direction things are moving in. It's all very bullish heading into earnings. Anything on the crypto front that has your attention? We had the Jupiter, the Jupe airdrop. I didn't get anything from that. That has had the crypto world and the Solana community a buzz. Everyone's expecting it to pump. It has, in fact, not pumped. It has actually dumped a bit because of all of the shenanigans there. We got Bitcoin still holding strong over 43K. You know, Jimbo said at 41 that we were going to be taking another big leg down. Well, once again, for the time being, Jimbo was incorrect. What do you want to talk about in the final few minutes of today's show before we wrap it?
Yeah, absolutely. I'll pull up Bitcoin. And again, crypto, I have not been. It's been so volatile and boring at the same time, right? We went to 42, and it looked like, oh, crypto is going to take a shit here. It didn't. And then there's also a lot of people that are just still fucking around in altcoins, and it's like some of them. I wish you the best of luck. I can't say that the liquidity is going to be there for forever. And again, this orange line here, it's a Bitcoin halving. We're going to see how that, if anything historical plays into this. I still think we have from the top here down at least 40% move to the downside. I think even more after the Bitcoin halving. So it'll be interesting to see how that plays out. But looking at this on the daily time frame, this is just pulled up on Coinbase. You can see that the volumes are dropping significantly since the ETF. It's dropped very bad on the daily. Now, if I look at this even closer on, say, the 4-hour time frame, you can see if we can see structure here. You know, we got 5-way move down here. Probably look for an ABC maybe. So we could look for 5 waves, and we look for 3 waves, and another 5 waves. But within that makes 5 waves here, 3 waves here, 5 waves here, and that pretty much causes a retracement. I'm looking at 45 to 46,000. 45. Yeah, I would say 46 probably the height I'd go. I was still thinking like 45 and a half is still pretty reasonable, but this move up here is a little bit more than I expected, and it stayed relatively high up there. I think a lot of that, again, capital flight from Evergrande. But I'm looking at this here. I think that if we don't put in a higher high, if we don't get to 50,000, and then we're just waiting for our wave 3 then, right? So our wave 1, our ABC within our wave 2, and our wave 3 will probably take us pretty deep, arguably 34,000 to maybe 30,000 or so. It's going to be a big move regardless if our wave 3, whether it's now or if it's after we get to 50,000, it's going to be a big move. But we're just waiting for that confirmation right now, and it just kind of sucks because we're not getting it. We're just kind of range bound. We're waiting to see if we get a little bit of a push higher. But if we do get a push higher, are they going to liquidate assets? We do know that there was I forget who it was, not Grayscale, but maybe it was Celsius. Celsius had a good amount of capital that they're still trying to liquidate. I think more so on the ETH front, but there's still a lot of people out there that are trying to get out of their crypto positions. I also like that FTX said that they're going to pay back everyone in whole. Guys, FTX is coming back. Maybe that's the exchange. Maybe that's the exchange after Binance, right? Going back to FTX. I would never touch FTX in my life. I would never. I thought about it there for a second, but I was like, no, I hate all these exchanges. Yeah, so I mean, looking at crypto right now, it just seems like we're waiting for confirmation. Maybe push up here if this move down is done on the 4-hourly time frame. I think there's maybe one more move down here, but it looks like for the most part it wants to push up. It's just that's a weak, shallow B wave, if anything, right? I don't like how that looks. And then you get something like that. Just it's not the greatest structure, but it's not up to me to decide if that structure's over. It's the market's pretty much playing. But I just don't think there's a lot of demand here. Again, with volumes dropping as much as they are, it doesn't seem like there's a lot of retailers to come in and buy up this Bitcoin. I'm not convinced. If I'm looking at Bitcoin dominance right now, I think we can take a look at that too. And then I want to take a look at gold because that's kind of scary right now. But yeah, Bitcoin dominance on, let's say, the daily, we're seeing that it is coming back a little bit. I mean, it's been up pretty significantly since January 13th. So it's making its way back up. But I think that in order for us to see this push all the way up higher, we need to see rotation of capital, right? So that means money from alts goes into Bitcoin. And then after that money goes into Bitcoin, that money goes back into alts. I think that's one way we get a big push up. The other way, obviously, is a massive sell-off. but primarily in the alt market, and Bitcoin stays relatively strong at current levels. So that's also possible, but that's what we're kind of waiting on. It's a very, I hate to say it's a waiting game, but it really is. We're waiting to see who makes a move. It's going to be institutions. It's not going to be retail. Retail is going to be the ones that are reactionary, not necessarily take action to initiate something like that. So crypto
Retail
just
might have put back into the market anyways, so it's like
exactly. It's they're still so behind on the fact that okay, there's a reason why they were dumping on us, right? They're not dumping on us in the beginning of a bull run for fun, right? It's and now I'm seeing ETF talk in May maybe for ETH. I don't know, guys. I think
oh,
you're doomed to lose if you're playing that game. Do whatever you want with your money. I'm not a financial advisor, but
that's the
best of
only
luck.
reason if that's the only reason you're bullish, I think that should be your first sign that maybe you're over leveraged and you're not in it for the right reason at this point.
I mean, it fucking worked out so great the first time, right, guys? Now no one gives two shits. Oh man, I can't wait to buy some HODL. I can't wait to buy some fucking ARC B. Yeah, fucking stupid shit. Not even. I mean, I don't even know, man. It's so dumb in the crypto market right now. So we're just waiting for something to happen. But let's take a look at gold, and we can finish it off there. And I know gold's so boring, but the dollar and gold are having an absolute battle right now. And
It's you and Peter Schiff hanging out talking about gold.
yeah, think about that. Me and him are both fucking bearish as shit, but one likes the dollar, one likes gold here. Who's gonna win? I don't know. I might have to scratch Peter. That's how I'm gonna win. Fight dirty. No, I'm just kidding. The dollar's a dirty old greenback. It's gonna win for the short term if anything bad happens. Let me erase some of this shit because it's hard to see. Yeah, no, it's even getting blind for me, but I understand the structures, right? What I'm seeing is this is our wave two. We got our wave one down here. So our wave two, I'm waiting to see if we do get confirmation that this wave is done with this ABC wave, because then I would anticipate a 5-way move to the downside. It's really interesting how overbought gold has gotten in the past few days, right? From the 26th all the way to where we currently are. It went from 210 to 2010 to 2054, even shot up to about 2065 today. So there was definitely something that spooked the markets. People felt risk off was the way to go. They thought gold was the answer. But I do think that gold is getting pretty dangerous, in terms of if this structure does play out. I'm looking at the stochastic RSI and everything like that. I'm like, sure, that matters, but it's not necessarily end all be all. We still have some room to go down on the weekly. So I think that there is still a chance that we are going to go below 20,000. I mean, not 20,000, 2,000. And there's a good chance that if that structure is deep enough and we do see a bit of a crisis in the short term, gold will do extremely well after the crisis. That's the way I see it. It's how March 2023 played out. It's how 2008 played out, more so 2009 when gold started to pick up. But it seems like gold is reactionary after an initial crash. And again, you need dollars to go into gold. You can't just sell, you can't just swap SPY stocks for gold. You're going to need cash to move into it. So it's going to be interesting to see if that DXY pumps in the short term, if we do get some type of crisis or a sell off in the market. And then if it does flow into gold at some point, but I do think that cash is going to be king first. And this could be just a blow off top of that ABC wave before we get another 5 waves down, which would probably take us something like this, maybe somewhere towards the bottom of 18 mid 18s. That's my theory right now. Doesn't have to happen that way, obviously, but you can also see how much the dollar is just bled this week and primarily today off of gold just shooting up as much as it did, right? Gold, the dollar, back and forth. The euro is weakening because they're still talking about rate cuts. The idea of rate cuts is becoming more of a possibility. The euro was actually down significantly this morning and it shot back up because the dollar's going down. Gold, it's all interchangeable. Everything is connected. But at the end of the day, the dollar is the one that is the reserve currency. That's what you use to pay off your debts. If you don't have enough of them, well, then you're probably going to do something very similar to China, sell off treasuries, print billions of dollars in yuan into the market and hope that the market stays level. Doesn't always work that way. So that's pretty much it on the Forex front. I got nothing else other than watching Meta today and seeing if they do well. Don't know if that's going to happen.
All right. We got Meta, Amazon, Apple, all of that reporting here in about 45 minutes. Appreciate everybody for joining us today. We'll be back tomorrow to discuss those earnings results. If you have not yet, hit the like button, subscribe to the channel, drop a comment. All of that is appreciated. Have a great day, everybody. Stay safe out there, and we'll see you next time.
Take care, everyone.